Hey team, hope you're well. Today I've got a pretty exciting video. I'm really excited about making this one. It's going to be going into depth about how to buy a property in New Zealand in 2026. If you're looking at buying your first home, this is the one you need to watch. I will go through everything you need to consider. I'm going to make it really concise too and not tell you things you don't necessarily need to know. This is going to be all the key details. And coming from the perspective of someone that's actually bought 2 properties in the last 12 months, has been working in the industry, working, hard 50, 60-hour weeks, trying to understand everything I need to know and what I want to share with my clients. I'm also not trying to sell you on the event of buying a property. I'm going to literally go into detail about everything you need to consider if it's actually going to be a good, long-term investment, whether it's, the own home you live in, or if you're going to buy an investment property as your first home. We're going to go through all of it, and it's going to be really concise, and really excited to share with you. So the first thing to consider if you are going to be buying a property is who you initially speak with, right? So I would say, if you're going to be arranging finance, which is probably going to be majority of people, you're going to need a mortgage to suffice buying a home. You can either talk with someone directly at a bank, or you can talk with a mortgage broker. Now, as most people are probably aware, with a bank, you only are going to get an understanding of what that bank specific products are. They can be quite good in some regards. I've actually made a video of like what's actually better between brokers and going directly to a bank. Both have some pros and cons. With a broker, their sort of involvement is maybe they're holding your hand more so throughout the entire process, and they work with all the banks and have a lot more maybe expertise in that regard. So personally, I'm a broker. I work with all the banks and I help with the whole entirety of the process for someone if they're looking to buy a new property or maybe get a better solution for their existing lending, maybe moving from one bank to another if that is a better outcome. But that decision is quite important. Both of the services are free for you as someone that is looking to buy a property. So that's an important distinction. I'll be going through, sort of my service and things to look at maybe more so in the video and things to consider. But we'll move on from that. So that's the first judgment you need to make. Now, in the event that you can look at buying a property, these are the fundamentals that you need to be able to have if you're going to get approved for a mortgage, or if a lender is going to give you any sort of money. So one is the servicing aspect. So you need to be able to prove to a lender if they're going to give you funds, you can afford the repayments week to week with your existing position. So this is something every single bank distinguishes a little bit differently. They all have their own internal calculators. I'm going to do actually a servicing assessment in this video, and I'm going to actually look at a specific example of someone, looking at buying a property and maybe how I would go about that specific purchase given the scenario. So we're actually going to go through the scenario of someone that is earning $72,000 per year, which I just searched up before is the average New Zealand income according to Gemini. When I searched it up, I might leave a screenshot of that figure. So we're gonna use that income in an assessment shortly. But servicing is an absolute core fundamental of something you must have if you're going to justify getting a loan and a bank to give you funds. Okay. The other one is the deposit or equity side. This is important because say in the event you look at buying a property, and you're buying it for $400,000, okay? Now, if you only have a deposit, say, of like $20,000, you're going to use your KiwiSaver and your savings. Now, this would be the future position, right? You might be able to service this debt, week on week with your existing position and your income, but the bank isn't going to really like the scenario because in the event that you're not cooperative with repaying this debt, now the bank is in a very vulnerable position, right? Because they might need to, say, do a mortgagee sale and sell the property so they can get their funds back. Normally, it doesn't come to the scenario until this gets really bad where you're not being cooperative with the repayments. But the bank is fearful that, in the event they have to do a mortgagee sale and then maybe they sell the property for like $350K, they're going to be at a loss. It wasn't a good deal for them, and that's the position they don't want to find themselves in. So they want to ideally see a scenario where the property's value is a lot more relative to the future debt you take on. So it does have significance of deposit and equity, and that's the reason why. So in this example today, I'm actually going to go through a scenario where, the person that is looking at buying a home, and in the example we're going to do is only has a deposit of $37,000. I say only, that's more than double than the deposit that I had when I bought my first home. I only had $17,000, but I looked again at Gemini, and that was the figure that was the average KiwiSaver and savings for someone in New Zealand. So we're going to use that today, 37 grand. Another pillar and another thing to consider is the credit. I would say these two are the absolute core. This is definitely necessary to have good credit. It's not reviewed as per maybe the commentary you see in the States where like credit is everything and there's all that discussion around that. But ultimately, like any lender in New Zealand, the thing they're thinking about is like they don't want to be exposed in the event that, say, you've had a history of not making debt repayments, and that's going to be them in the future, right? So there has to be some sort of commentary, ideally no, missed repayments, especially in recent times. But this is something that they definitely consider, right? If they're going to give you funding, they have to have certainty you're going to make the repayments back and have a history of doing it as well. But like I said, it's not maybe so much considered maybe compared to, say, like American applications, even though I haven't really dealt with any like American lending applications or anything. It's still something to definitely have that is in the green or something good, right? Because they're not going to give you the funds if you've got a terrible history. So those are the three core fundamentals. Now let's just do a quick overview of, say, if an application is to be sent to a bank in the scenario that we just presented. So say someone's income is $72,000 per year, maybe they're contributing 3% to their KiwiSaver, and they don't have any debt. I think I might have said like they have a $5,000 credit card. That's probably pretty reminiscent of a lot of New Zealanders' situations. So I'll include that in this assessment. Now, in the scenario where there's just one applicant, in this application, I'm assuming they've got one personal vehicle they have, and then they will have these fixed obligations when they buy a property. Maybe they've got $250 for insurance, $250 rates as their future expenses when they buy a property. I'm gonna forecast all of these expenses in this scenario. So with my calculator as well, I'm also going to input here that this person buying a property might have a flatmate or a boarder when they eventually buy the property, and they're going to get $200 per week. So in this scenario, my calculator is saying that there might be borrowing ability of a maximum of $466,000 if they want to do a mortgage application. This is what they could afford week to week. Now, it's not necessarily what they could borrow necessarily. We'll get into that because there is the deposit and equity constraint. Potentially, if they only have $37,000, maybe they can't get all this lending necessarily. But we'll go through that more as the video goes on. But another thing to consider as well, like maybe if there are additional expenses, maybe for like things like entertainment, personal care, maybe the subscriptions are a little bit higher. If there is a higher recurring monthly expense, that's going to reduce how much max borrowing is available. Maybe in the event this person doesn't want to have a flatmate and they have an additional $400 per month that I hadn't forecasted in, now the borrowing assessment goes down to $300K. So if they've got $300K they could borrow in this regard, plus 37 grand for their savings in KiwiSaver, that's looking like the maximum purchase price this person could buy for is $337,000. The next side of the thing to consider is the different products available based on how much of a deposit you have. Okay, so at the moment, if you're a first home buyer, there's basically four different levels, I guess, of deposit you can have. So the lowest is 5%. 10% is another, that's very common, 15% and 20%. Okay, so if you have a 20% deposit, the bank or lender will basically say, look, if you're going to live on this property, we're going to give you the best cash back and interest rates on the market. Currently, the most competitive 1-year fixed rate across the banks right now is 4.49%. So I've put that there. Now, if you have less than a 20% deposit, which is very common, I would say more than half of New Zealanders in the last few years at least have bought with less than a 20% deposit. It's very common and very normal. However, for the banks to mitigate their risk, what they do is they say, yep, we'll give you the funds, but we're going to enforce what's called a margin in most cases. There are some exemptions, some different scenarios where this margin might not necessarily be applied. I don't actually want to go too specific with each different bank's products, but this is like a general overview of how banks justify giving funds in a scenario where there's less of a deposit contributed. So 15%, we're looking at an additional marginal interest rate of 0.25 generally, 0.75 at 10%, 1.25 at 5%. Okay, so these are the rates that can be expected if you're going to proceed with that. So in a scenario, like I said before, if a client's max borrowing is $434,000, and in the event that $37,000 is going to be used as a deposit, this would be the max purchase price. However, the deposit in the scenario, if I take the deposit to the max purchase price, that basically gets to an 8% deposit in the scenario. So it would be a little bit less than 10% offered here. So in the event this person was going to proceed with this and buy up to a max of 470, which is what they could do, this is the interest rate they would probably likely have, or around about this margin. Now, there are quite there aren't many options with a 5% deposit in the market right now, just purely because of the risk to a lender in the scenario, right? Like if you're, say, buying for 470, or the max that this person is eligible in the scenario I'm presenting, and the exposure here is 430K, that lender is pretty exposed. So there is one main bank solution that is offering, that option with that 1.25% margin. And there also is another option through the first home loan, which is through Kāinga Ora. Now, how that process works, if you're aware or unfamiliar actually, is these banks offer it, okay? ASB, Westpac, Kiwi Bank, SBS, and there are some other lenders, I think like Cooperative offers it as well. So in this regard to the first home loan, there are some requirements needed, and I probably won't go so much into detail with it. Like I said, I don't want to go too much into detail with the specific products itself, because there's so many different scenarios, and what's going to be best if you have a 10% or 15%. But ultimately, through the first home loan, you can have as little as a 5% deposit. These banks have a relationship with Kāinga Ora, so they will assess an application originally, and then they will verify with Kāinga Ora if they're eligible for the parameters that are set by them. So with Kāinga Ora, they say, look, if there's one applicant involved in an application, there's a threshold of they can't make more than $95,000. They have to be working with the same employer for 12 months or within the same industry for around 24 months. And another thing is they can't have more than $10,000 of personal debt, I think it is, or it could be $15,000 as well. So these are the requirements. And if they are eligible through this, the client, the benefit is that they might be able to borrow a little bit more funds compared to, say, like a traditional application where there's less than 20% deposit. So that's one aspect that can be quite good through this product. If, say, that client maybe wants to buy for a little bit more than this, because my calculator is a little bit conservative, and plus it's not reflective of the actual bank's calculator. It's kind of like a combination of all of them. And another thing with this product is they actually capitalize the margin on the loan. So what happens is rather than the rate being, say, 5.74 week on week, this 1.25% margin is actually added to the loan balance. So say in the event 430K is the loan, what will happen is this will be added to the loan balance. So the actual added amount will be 5,375 on top of the loan. So it would be this plus 430K. And that is the future loan and how that works. But you would have a rate reminiscent of whatever the rates are with a 20% deposit, basically. So those are the options for that specific client needs. If they're wanting to buy for probably more than 450K, no, actually it would be more than 370K, because they would have less than a 10% deposit in that regard. Furthermore, if someone is looking at buying an investment property, these are the options available right now. So there's only one product available for an investment property with a non-bank lender if you have a 10% deposit, and that rate is 7%. This is for an existing property only though. If you're looking at buying a new build property, main banks will consider it with a 10% deposit. The reason why they will, for new builds exclusively and not existing, is they're trying to encourage these tradies and all these people to do this works because it's good for the economy. So they say, look, any bank or lender that is regulated by the Reserve Bank, the Reserve Bank says, look, this is an exemption. We want to encourage people to build and give people the ability to buy and not be penalized for having, say, less of a deposit, so they can buy these products basically for an investment property. So that's the reason for that. The interest rate might still be slightly higher though than if you say you have a bigger deposit. So I put 4.99 as like a rough guide of like what you could expect in terms of interest rate if you've got that level of deposit for a new build investment property. 20%. So this applies for an existing property. Maybe you can get a non-bank solution, maybe around 5.5 to 6% if you want to take that route. And then 30% deposit is the requirement set by the Reserve Bank of New Zealand for new lending on a investment property for an existing property. So those are kind of sort of the broad options available. But when you're watching this video, maybe if it's months into the future, these things can change all the time. It has quite a big dictation on the property market, depending on what solutions are available. Like when I first got into the industry, 5% wasn't an option. No one could buy a property with a 5% deposit. And I know a few years ago, like there was, you couldn't buy an investment property for an existing dwelling for less than 40%. And I know in history, you could have had a 20% deposit at the main banks. That was the guide the Reserve Bank set. So these things can change all the time, but just as right now, these are the figures set by the Reserve Bank and main bank lenders as of right now. So yeah, this is for owner occupied properties, and this is for investment properties. Okay, so now ideally, there's a bit more insight for your position for what you can achieve with your scenario, right? Like say, you might actually be looking to buy a property with two people. We can add in incomes here, and that might increase, your serviceability based on the numbers that are inputted, right? Something I can actually analyze for you is something someone directly at the bank could probably analyze for you as well. But the idea from here is now you have an understanding of, the fundamentals of what's required if you're going to buy a property. But there's another element to it, because just because you can technically afford to buy a property and you're eligible for all these products based on what I've said, doesn't necessarily justify if you should actually buy a property. So now we're talking more so about the analysis and how to actually go about maybe finding a property, and actually if it's worthwhile buying a property itself. That's ultimately what we want to look at now. And this is probably the element where most mortgage brokers won't get involved, but I think it's necessary that you have an understanding of what you're getting yourself into, and not just purely buying because you can buy. So we're going to look at some properties on Trade Me now and actually look within the realms of this person's scenario that I've been going through in this video. Now, it's a little bit tricky for me to come up with a location for this video of where someone could look to buy. I think ultimately just because of the client scenario, there's probably pretty limited options, especially in Auckland. I know, and maybe you guys have seen this as well, if you've watched my videos before, is I bought a property in the central Auckland area, 2-bedroom unit for $327,000. So it's possible for this person's scenario that they could buy in Auckland potentially, but it's going to need to be a unit. And I want to have some variety of options for this video just to showcase, what is possible for this person. So, they could look to probably buy something in Whangarei. I know in the Whangarei market, there's a lot of 2 to 3 bedroom homes available that, could be secured with finance for less than 500K, like this person is eligible for, up to a max of 470. Tauranga is probably a market. There's not a lot of stock available in that person's price range. Maybe there's something in Hamilton, in Rotorua. But what I think I'm going to do is I'm actually going to look in the Wellington market. I'm originally from Wellington, so I'm going to look at, properties in this area, some things that I would consider. Obviously, there's probably not going to be as many properties available within this price filter I'm setting, just because of the nature of Wellington being a capital city. There's not as much stock probably within these price ranges, but we're still going to look anyway. And I'm going to take you through the process that I'd be looking at if I was trying to source a really good property and one that makes logical financial sense, right? So I always like to filter by map view as well, by the way. So this, what I've got going on, this just gives me a little bit more flexibility compared to say the filters on Trade Me when I'm searching for properties, right? Like if I search in Wellington and then it's giving me such a large variety of potential properties I don't want, depending like as an example actually of this, when I was searching on the map viewer before, it's pretty much me excluding the Wairarapa area. So maybe I'm not interested in properties here necessarily, but I know there are quite a few properties in Masterton exclusively that could maybe be pretty good deals, and there's quite a lot of stock there that is maybe more so within my price range. But I've got to keep in mind, maybe if you're looking at buying in Wellington as an owner-occupied property, maybe you don't necessarily want to buy in Masterton because maybe you work centrally and you don't want to have that commute each day. I'll search in this area for now. Another thing I like to do when I'm trying to navigate and go through properties is I will normally filter by lowest price when I've set the price filters I want. The reason why is it gives me an idea of what properties are roughly going to be going for when I'm searching through, because right now we've got these two listings that have got like a price set, 350K, but this one is priced by negotiation. So I know roughly the agent that's listing this property is sort of setting the expectation here that that's what the property will likely be going for. Okay, so I found 4 properties that I think could be something that this client could consider with less than, let's say, a 10% deposit. And then we're going to go through these 3 properties actually that look good on the surface in terms of the price required, but a bank wouldn't necessarily give the finance on in this person's scenario, and I'll explain why. So for this one, this is a property in Trentham. It's a unit, 385,000. So in this scenario, probably pretty close to 10% deposit, just roughly with how Homes is valuing the property. This is actually obviously way off. This is probably the whole complex or whatnot, but maybe we'll look a little bit more and justify if this one's a little bit better. Another one, this one is a little bit further out in Masterton. So I've got this example here, should be fine for finance just from me inspecting the photos. Again, like I haven't done much due diligence on these properties, guys. I'm not necessarily saying they're good buys or recommending to engage in them in any way. I'm just purely trying to show an example of how to go about the process of buying I've also got 2 properties here in Featherston. This one, 395. Here are the photos. So it needs maybe a little bit of a cosmetic renovation, but in terms of like it being structurally sound, I didn't see in the description that there's any disclosure. So I think getting finance would be fine on this one. And I think relative to how homes had the valuation for the property, it's a little bit higher. So maybe there's a bit of a discount. Another one I found in Featherston here, 410K. And I think this is on an even bigger section. And CV's 470 and valuations are here. Also sold in 2016 for 200K. So the person that's selling the property has probably made a pretty decent margin on that. So maybe they don't necessarily need to sell it for top dollar. So that kind of gives you a bit more room on the negotiation. But again, it's obviously subject to, the property being fine. But it looks from how it's being presented that, finance could be attained with even less than a 10% deposit because of the work needed. Now, here are 3 examples of where I think they could be good deals in terms of where the area is. However, I do think getting finance would be a big problem on these 3 specific properties. So this is the first one. This is a 9i, pretty close to where I grew up in Petone in Lower Hutt. Now, the thing with this property, on the surface, it actually looks, to be honest, pretty fine. Like structurally, it looks okay. But one constraint I saw in the description when I looked at this property is that it's being sold as is, whereas, see, this is this here. Now, the problem with this is if a bank sees that it's being sold as is where is, they don't necessarily know if there's any problems with the property because it's being disclosed. That's how it's being sold, as is where is. Like, if there's any unconsented work or if there's any, requirements needed or if there's something not right with the property, that isn't being disclosed to the bank necessarily. And that puts them in a scenario where they could be quite vulnerable, right? In the event that the person repaying the debt, is not being cooperative and then they need to sell it again based on this, it kind of just adds more risks to the lender, right? So they're probably not going to be so keen in that regard. Normally, if you're buying a property that's being sold as is where is, you're going to need to put more skin into the deal or a higher deposit, 20% deposit or more is generally what would be needed. Another one is this property. I actually have had this property on my radar. It's one of 2 townhouses. So I think, there's townhouse here that's kind of separated by this pipe that's hanging down here. Now, on the surface, like 400K to buy a property in Karori, 85 square meters. And I think the interior looks, pretty nice. Like this would be pretty good buying. I think the home's valuation is sitting at, let's have a look. Pretty, very, very high relative to what you can pick it up for. The problem with it though is just the cladding. I've done some further due diligence on this, and I know everyone that's come through is having the same problem with it. So just with the cladding, it's what's called or referred to as plaster. A lot of banks don't like it because they think the longevity of the cladding is not long, I guess you could say, right? So that could mean that there's a lot of extensive work that is going to be needed to reclad. Plus, with the other person owning this townhouse, that can be a problem as well because they might not have the funds to do the cladding and everything. So if you're getting funding of say you're buying for 400K in this scenario and you're contributing 37 grand as a deposit, future lending's 360K, all of a sudden it needs a huge reclad. You don't have the funds to do it. You're living in a home that's got water ingress and water moisture and all this stuff, and in the event that say you're not being cooperative with repayments and the bank needs to do a mortgagee sale, it might not even sell for 200K or 250K or whatever because of the work that is needed, and it's such a big headache for someone. So that's why the bank is not very motivated to get involved in a deal like this, especially with a low deposit. It could be quite tricky, and especially with this constraint of like maybe somebody owning the other townhouse. Another thing too, the rates are reasonably high here, but it's just more so the cladding is the thing that's disrupting of finance being approved in this regard because it's just too high risk in this scenario. So that's an example. Even though it does look like a great deal on the surface, that's the constraint in this regard. Another one here too, like I've seen this being on the market for like over a year and a half, I think now, but it just needs extensive work. It's in a pretty desirable area of Wellington, like very, very close to the city, and I think they want like 400K for it, and the CV is like $1 million as of right now. But just because of the work required, like it's extremely significant. Like I haven't really done that much due diligence on it because it's way above like anything I would consider doing as a project right now with my position at the moment. But yeah, this is just one like there's no way finance could be attained, especially with like 10% deposit. You probably are going to need maybe 40-50% deposit for a lender to get involved, and there's going to need to be numbers and understanding of like how much funding is required for the work to be completed and a whole bunch of variety of things to be done on this one. So that's just an example of something that couldn't be obtained for like a first home purchase because the property itself is just too risky to lend against. Okay, so what I think the best thing to do from here moving forward is to look at if they were going to buy a property for $400,000, because that was sort of the range for what all those properties were going for the Trentham, the Masterton, and the two properties in Featherston that I just found just then. So let's use an example of this person buying for $400,000. This would be their future loan, maybe with the margin of 1.25% that's added on top through the first home loan would be added in here. So we're looking at times 0.125, so it's 463. Plus this figure here, 367 as the loan. Now, ideally, the online valuation for the property or the bank valuation would be higher than what they're buying for. So I think when we looked before, the average sort of valuation was sitting between 450 to 500,000. So in the event that that actually is the scenario where they're buying for 400K, but the property is actually valued at this figure, now this presents some opportunities, because now it means all of a sudden that they technically, based on the online valuation, have more than 20% equity in the property. So that presents some benefits, because in the event where if they go to, say, main bank lender where they're charging a margin on the interest rate, so rather than having 4.49, which is what it would be in this scenario if it's capitalized and added to the loan like I'm assuming here. So if it's not capitalized like this, so if I remove this now, and this is the position based on the bank valuation, now it can be requested that rather than the interest rate being 5.74 or 1.25% above the interest rate of 20%, this could now be changed to the rate is 4.49. And that could be a difference of, say this, so the loan here, let's say it's 363, interest rate is 5.74 with the 5% of that main bank solution that's not through Kāinga Ora. 488 is the weekly repayment. But if there is that discount and margin there now with how the bank value is sitting, the interest rate could be as low as, say, 4.49. And now there's a weekly difference of this, which is $64 a week, which maybe doesn't sound like a whole lot, but when you're, extrapolating this over like the life of, say, 1 year, like we're doing in this scenario, that's another $3,000 per year in savings, which could be quite significant. So this kind of justifies further that, like, if you're going to buy a property, especially when it's maybe less than a 10% deposit, you're trying to buy really well, so you can set yourself up for the scenario. Now, with the bank valuation, this is actually something we haven't covered before yet in this video, and we're going to go through it a little bit now because, again, it does have quite a bit of significance. So right now, I'm currently looking at 118 Lincoln Road, which was the second property we were looking at that's in Masterton. The bank is currently valuing that property at $535,000. I can't exactly remember what it was on Homes, but basically what this means is that a few banks or main bank lenders in New Zealand, if an application is submitted, they will use this valuation in an application without requiring what's called a registered valuation, which we might touch on in a second too. I'm going to show the other Featherston properties as well. I couldn't actually get a valuation for the unit in Trentham. So this is the bank valuation for the first Featherston property for Hardy Grove. And this is the bank valuation for 38 Wakefield Street. So this is the other Featherston property. Also, another thing to note is there are actually multiple sites. So both CoreLogic and this site I'm showing you now, Velocity, that has valuations. So again, on this site, it's 465,000, the online valuation. So it looks like this Featherston property and the one in Masterton presented the most value. I think this one was available for inquiries over 410,000, and the one in Masterton, I think, was inquiries over 395,000. But for both of these, maybe they've been secured already by another person, or maybe there's extensive work that I don't necessarily know. From the photos, it looked fine and there wasn't anything disclosed in the description. But these are just things that I'm just showing you how I would navigate when finding a property. So another thing with the bank valuations as well is, for most main banks, what they say is that they will always take the lower of the two between the purchase price and the bank valuation or the registered valuation that is utilized, just because they don't want to leave themselves in a position where they're lending against say this valuation if it's just happened, because that's not reflective of what the property is actually worth, because you actually bought it for less. So they will always take the lower of the two. Another requirement, which we'll talk about when making offers later in the piece, which is something we're going to go over and how that whole process works, is there will be a requirement that is needed for a bank to give the funding if you're buying with less than a 20% deposit. And that is a registered valuation, which I think I may have possibly touched on before. Now, this is required because if a lender's going to give the funds and you're buying for $400,000 and your loan is actually going to be this amount, 363, they want to make sure that the property you're actually buying is actually what it's worth, right? If you're buying a property for $400,000, but it's actually worth $380,000, now they're even more exposed, because like you're actually buying it for more than what it's actually worth, right? So now this ratio is even higher. So they actually say, look, if we're going to give you the money, you have to pay $1,000 for a regulated valuer to come inspect the property and give us an indication of what it is. So ideally, it comes back at what you're buying it for, or preferably more so, even more, right? So like the bank valuation and the comparables are saying it's around this level, which is giving you a bit of further insight to maybe justify it. It's a good deal when proceeding, right? So those are some things to think about as well. Probably the most important thing to consider now is like, does this actually make sense, right? Like, even though you're buying it on a bit of a discount, maybe you're getting, like in this scenario, maybe a 20% discount on what maybe the property is actually worth, right? Obviously, this might not be what the registered valuation comes back, but we know the bank will lend on this at the time of an application, maybe 6 months after settlement has occurred. But the really critical part is understanding if it's affordable for your position week to week. In the scenario, say we're buying for $400,000 for legal costs and evaluation, it might set you back actually around $4,000 for this purchase. For both the Masterton property and that second Featherston property, I don't think there's much renovation work required. It probably would benefit from some cosmetic uplift, I suppose, but it's not mandatory. The deposit, we're looking at $37,000, and then the loan would consist of $400,000 minus the cash deposit. So this is the loan amount. Now, in the scenario we did here with the servicing assessment, I did assume $200 per week. So I will input that in this scenario because it's just one applicant and there's multiple bedrooms. I think both the Masterton and Featherston property were 3-bedroom homes. So I'll put $200 per week in rental income. I'm going to assume 5% is the interest rate, because in the scenario, there might be a temporary amount of time, maybe there is a higher margin on this, but this could be the long-term rate. Maybe once you display, you've got 20% equity in the property. So we'll use 5%, principal interest, 30-year loan term. Okay. And in terms of commitments, I would say for insurance and rates, maybe $4,000. I know in Wellington, maybe not necessarily the Wairarapa, but it's probably one of the more expensive areas in the country. So we'll use that. Repairs and maintenance, I'll use 1% of the purchase price, no property manager. So the total annual cost, including interest, of $34,000 per year. But because of the rental income of $200 per week, that's being offset by $9,000 per year. So in the scenario, if you're buying this property, there's actually $25,000 it's going to cost you year on year just to hold this property. But the benefit is maybe you're going to get that capital growth upside, plus you're also buying on a discount, right? So in the event, like I mentioned before, if the property market goes up by 5%, 470,000 times 5% is 23,000. So in the scenario too, obviously you are somewhat paying the balance down further. It's on a 30-year loan term, so a lot of the initial repayments will go towards the interest. So for example, if I put the information here, $22,000 here is what the repayments are to the bank, but of that $22,000, such a large majority of that is actually going to the interest repayments initially. So because you're basically paying 4.49% of this amount year on year just in interest alone, barely anything towards the principal. So I think before, $22,000 was going towards principal and interest, but $16,000 of that $22,000 is going towards interest alone. So there's only $5,700 going towards the principal year on year. But eventually, as time goes on, say, the position next year could be, say, the property is worth $500,000 and the debt reduces by $5,700. And now there's that spread between what your property is worth and your debt, the property value going up. versus the debt going down. But there are scenarios where, like most recently in the last few years, property hasn't appreciated 5% year on year. Like most recently it's probably been the inverse, where it's actually gone down 5% year on year. Plus it gives you that security you've actually got a place to live in too. So, from this scenario, this could work for someone, but ultimately, like the part where maybe I can come into play, and maybe someone direct from the bank, hopefully too, but probably more so from an advisor and expert in the space that works with a lot of lenders, they probably will do this analysis for you, and especially something I do. You can probably tell by how I talk and this video I'm making that's pretty long. I really care about my clients and getting the best outcome for them and making sure they're very informed about this decision that they're getting themselves into. If they're going to be doing it, doesn't make sense. Is it a good investment long term? Comparing it to what you can have for rent, can you buy it on a discount on the cash flow? So that's part of the analysis I do. Now, the final bit of the process that really needs to be thought about is, like, once you've actually found a property and you want to maybe look at making a move and making an offer. Now, there are some things I recommend doing, or application methods that are done to the bank anyway that need to be gone over. So one, which you may have heard of before, is called a pre-approval. Basically what this is, it's basically just a letter or a PDF from the bank saying you can buy up to X amount. So for this scenario and this person, what they could do is they could get a pre-approval saying like, hey, John, or hey, Stephanie, or whoever this person is, we will let you borrow up to, whatever the amount was. I think it was like 430K when I put the scenario in before, because it was just one applicant. You might be able to get a letter saying like, yes, we will let you borrow $434,000 from us. It's just conditional on you finding a property that fits, like is going to be all right on our books. Doesn't need too much work. So that's basically what a pre-approval is. Normally they last for between 60 to 90 days, depending on the bank and how much you have as a deposit. But that's what a pre-approval is. It's not like a certainty you can buy a property just with the pre-approval, because it's conditional on the property being approved by the bank as well when you find one. The other one is a live deal. So a live deal happens when you've had an offer accepted on a property, and then you present that to the bank and say, look, it's good to go. Can you please give me the funding? I've had this offer accepted. I've got 10, days to arrange finance. Can we please have this deal approved? And that's something that I would send to the bank as well. So there's two variations of applications I can send for a new purchase. One's a pre-approval. One is a live deal application. So that's just from my end. But if you're going to be making offers, there's two types of offers you can make on a property. One is a conditional offer. So you can say, hey, I will buy this property for $400,000 on the condition that I can arrange finance, whether that's directly with the bank or say through someone like myself who's a mortgage broker, because generally it might take, say, 5 to 6 working days to get a response once a bank has collated all the documents and have everything they need to assess if this scenario makes sense, right? So you can also make conditional offers not only just for finance. You can make them conditional on a satisfactory building report, or your lawyer reviewing the property, or based on a land and information memorandum being sufficient, which is like basically just a document that just goes through the geography if it's in a flood zone, and like some other elements to consider about the land. There's multiple things that you can do, and it's all up to interpretation with property and negotiation. So you can ask for additional things and conditions when making an offer. It's required because if you make what's called an unconditional offer, where you don't have any conditions and you make an offer without anything, you are legally obligated to proceed with the purchase. So that's important to note, because that can be quite significant if you make an unconditional offer, because now legally you have to go through with the purchase, and there's quite serious ramifications if you don't. So more often than not, conditional offers are a way of doing offers on property with having protection. Because then you can just instruct your lawyer to say, look, I haven't been able to achieve finance. Can you please pull out of the agreement? But you had the opportunity to buy and proceed at that price because you had secured it for that amount of time. So ultimately, I like to say when we get to this part of the process with the client, because this is the final stages, is when I will spend a lot of time going through this and making sure the client is fully aware and set up with a lawyer, so they know that they can protect themselves, maybe clauses to consider or think about, so they're aware of how they want to protect themselves, and putting a good offer forward that makes a lot lot of sense and, stacks up in terms of the cash flow and the valuation. But these are only necessary when, the due diligence is complete, and if you're partaking in an auction. So auction, personally, I'm not the hugest fan of them. Like, I've been in the industry for 2 years. I haven't had one client successfully win an auction, maybe because I just care so much about my clients buying for good deals, to be honest. But I don't know. They're just a bit of a different beast entirely, because you have to be in a position where you make an unconditional offer if you're going to bid at an auction. So you have to do quite a lot of due diligence up front, especially if you have less than a 20% deposit, because you need to pay $1,000 for a valuation to get sign off for finance, builder's report, and all those things. And you're competing against probably people that have a larger deposit than you. That puts you a bit on the back foot if you're trying to get a good price. So yeah, auctions, that's required with unconditional offers. But another part, when you find a property is the negotiation part. And this is where maybe someone like myself, or someone that that has a lot of properties, can be quite helpful. Like, some examples of negotiation is, like, we looked through a variety of properties before. 2 of them were in Featherston. So I probably would look to maybe even potentially look at making conditional offers on one of them, or maybe, talk amongst them and say, look, I've seen this property, I've seen this one. I like this one more. I've looked at the bank valuations and everything. I'm probably prepared to make an offer at $400K on the one that had the 470K bank valuation. I think it was 38 Wakefield Street or whatever it was. But I would also go to the other Featherston property and say, look, I'm making an offer probably at 400K. I've seen the valuations and the work required. I would be open to buying this property, but I would only be buying it at 350K. Would the seller or your vendor consider an offer at 350K? I would still need to arrange my finance through my broker, or through me if you want to use me, or through the bank directly. But you can start doing those things and start using that wording a little bit more so when that time comes. And again, like I said, it's all kind of case by case and scenario. But the thing here, once you find a property, is making sure that you've got enough time to arrange finance for whatever you're looking to do. So getting your ducks in a row for this stuff, if it's the pre-approval first. So you fast track, when you find a property, you've already got that good to go. It's just signed off based on the property you're buying, so the bank's happy. Live deal you can do, but you just need to arrange time through a conditional offer to make sure that this can be assessed. And like I said, for a bank to look at something, it's probably going to take 5 to 7 working days. So you might need to make a conditional offer of 10 working days. So you've got enough time to have, say, this approved, and then have some time to maybe get like a registered valuation, which takes another 5 working days generally, but it can be done within 3 working days, but it just does cost a little bit more. But ultimately, I think, when you get to this stage, this is when you need to start chatting with lawyers, maybe mortgage brokers or direct to bank, with handling this whole process, so you know what's going on. It's just so much case by case for every bit of this, and if it's worthwhile doing or not when it comes down to it. But ultimately, guys, that's pretty much the whole process of how to buy a property in New Zealand right now. So just to summarize again, what we went through is just like who to talk with initially. So now you probably have got a bit of an understanding of what one is going to be best for you here. Maybe even both if you want to try both. Fundamentals. Look, we got the servicing. That's important. You've got to be able to prove you can make the repayments week on week with your position. Deposit and credit is absolutely essential if you're going to get approved for finance. The products available, we went through them and why they exist. Finding properties, I like to go on Trade Me. You guys saw the parameters I use and how I filter by map view. And then maybe once you find a property, add them to your watch list, going through the analysis, ideally buying on a discount, maybe looking at One Roof, realestate.co.nz, and home, seeing how the value compares, maybe reaching out to someone like myself who can review the bank valuations because they obviously have some significance. Looking at the cash flow, maybe seeing how it compares to your rent. Does that add up? And is it going to be a good investment long term if you're getting that growth relative to how much it's going to cost you to own that property year on year? And then once you find a property and want to make an offer, these are the things to think about, like we just went through. So that's everything, guys. That's what I would want to know if I was looking for finding a property. I know it was a bit of a longer video, but figured it would be helpful for you guys. So hopefully you guys enjoyed it. If you want to reach out to me at any time, my stuff is in the description below to reach out, and I can help you with what it is you're looking to do to the best of my ability. And if you want to watch any more of my videos, I'll leave them on the screen. Cheers, guys.